Hi, we're here today to tell you the statistics that came out of the most recent jobs report for the month of May and give you some indication of what's going on and how that is impacting the real estate market. The Bureau of Labor Statistics in May reported about 2.5 million jobs that were back online. The statistics reported, and this is US-wide, showed that food service and bars were the highest industry that went back to work. That stands to reason because everyone needs to eat. Hotels were the second lowest industry to start back to work, and then the lowest was the government.
Along with the latest job report and the unemployment numbers, there was a lot of discussion about whether there was a miscalculation. We were able to get some numbers from the Bureau of Labor Statistics that took into consideration the miscalculation numbers that were reported throughout the U.S. And what it shows is that in April, the unemployment rate was showing as 14.7%. With the miscalculation, it's actually 19.7%. But the good news is, if you look at May numbers, the unemployment rate was originally reported as 13.3%, and in actuality the miscalculation shows it as 16.3%. What's important to see is that there's a bigger decrease in unemployment, even factoring in the unemployment miscalculations. So what this shows is that we are getting more people back to work, less people on unemployment, and the economy is starting to recover. Now, what that means in terms of actual activity in the marketplace for housing, we went on Showing Time, which analyzes the number of showing requests for buyers wanting to see new homes. Now, these are nationwide statistics, but it's really important to see that the number of showing requests, the latest numbers, are actually well above where they were before COVID-19 came into play, and we were having an extremely robust season at that point. So activity is definitely on the upswing in the good indicators and downswing on the bad indicators.
So the majority of economists have been saying that they expected a V-shaped recovery, meaning that recovery was going to start in the third and fourth quarter of 2020. Let's hope that we do see that. There's also a lot of talk about another resurgence of COVID, and let's hope that we do not see that for the sake of the country as a whole. And what we're hoping is that these good, brisk showings are also an indicator of the buyers who are willing to say, hey, I see that the interest rates are low. As of June 12th, we hit all-time historical rates since the 1930s. Interest rates were between 2.75 and 3%. So when you look at your appreciation expectation, even just for 2020, being conservative, we're looking at about 3% across the board. So if you're paying 3% and your appreciation is 3%, you're break even. And then of course we're going to be moving on as we come through more and more recovery years, and we will be seeing those appreciation rates pick up on your housing. So if you can buy now, or if you're considering refinancing into a lower rate, that will definitely help you with your cash flow and possibly take you into a shorter term mortgage to pay off your home sooner. Now is the time to get connected with a great lender. And it can also start with getting connected with a great realtor who knows a great lender. So don't hesitate to call.